Talk to me about these fines. I wasn't aware of that. What fines are, and by what governing body? I mean, these are the same governing bodies that these banks are lobbying to, create policy that's in their favor. Who's fining who and for what?
So it's OSFI that is finding, like CIBC was the latest one to get fined, and they were noted, I guess a big investigation happened, and they said, hey, a lot of your mortgages were funded based off of like just terrible underwriting and some documents that are not real documents, like a little bit of fraud activity in there. But more so, it's just, hey, like the ratios are out of whack here. How are you approving these mortgages? What's going on behind the scenes? So those are that's how that was the latest lender that just got wasn't a huge fine, a couple $1 million, but a fine nonetheless.
Isn't OSFI also the governing body that dictates how far amortization can be stretched on these loans? Isn't that the same governing body that pushed it from 20 years to 25 years to now 30 years? Isn't that the same governing body that is probably going to push it farther because we're stretched way too thin already?
You got it. You got it.
Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify. Jeff Mudrick, thanks for taking the time again to come chat with us. So the Bank of Canada just held the policy rate at 5%. What's your take on this?
Yeah, I think it was something that kind of became a bit more clear over the past week, that the Bank of Canada was going to hold the rate as opposed to continue to increase it. There's no talks about decreasing it anytime soon. But just with really what's going on in the world right now, a lot of uncertainty. Inflation numbers are coming down, but like the geopolitical climate is one that is scaring a lot of people. So to hold the rate is not as much of a surprise as it maybe was last month or at the beginning of September.
And in terms of just the fixed versus variable, because that seems to have really, that gap has widened. And it seems that we've seen a massive, just monstrous kind of just decline in sales volume over the last, let's call it 45 days at this point, maybe 60 days at this point, because it seems bond yields have risen, fixed rates have really started to climb very quickly. Talk to me about that. Why is that happening? How has that maybe influenced the decision today?
Yeah, for sure. So they quoted in their report, they said, hey, we're seeing the effects that these higher interest rates, these increase in interest rates are having on the economy, on the housing market in Canada, which is something they haven't really mentioned before. So I thought that was pretty interesting. And so they're recognizing that. The idea around like fixed versus variable, from like a consumer, from a client perspective, it's a very, very interesting time. As you mentioned, Adam, rates have risen. Bond yields are continuously skyrocketing. Every 3 days, we're getting notice that fixed rates are rising. And yeah, the gap is not so much a gap anymore. There's a gap in certain areas. So if you're thinking about taking a 5-year fixed term today, sure, there'll be a pretty significant gap between that and a variable rate. But not many. I haven't sold or haven't talked about a 5-year fix in a long, long time. But when you're looking at 1, 2, 3-year terms, they're all like around the same as what a 5-year variable rate would look like, which makes it a very, very interesting conversation to have with clients.
In terms of the sales volume dropping, I'm sure that you've seen that on your end as well. How are those decisions being looked at just from a financial perspective? How are people crunching the numbers and coming to the decisions that they're coming to right now, particularly for buyers?
Yeah, so huge decline in sales. That's across Canada, really. It's not unique to Toronto or the GTA or Ontario. It's happening all over the place. So why is that happening? Well, if you're wanting a $500,000 mortgage, which a few years ago was not a big amount, now you're spending about $3,500 a month on that mortgage. So really, once clients kind of get that laid out to them, it's a scary number. And when you're factoring like fixed expenses, you're factoring in mortgage payment, property taxes, if maybe there's some condo fees. If you're getting a mortgage at 500,000, it's likely a condo. All those fixed expenses add up, and it's scary to borrowers when their grocery bills have increased, when gas prices have increased, and just their total living expenses have skyrocketed over the past 18 months.
So for those people who are looking to secure housing for themselves right now, and in particular buy something, what are you recommending for them to do at this point in time, given the current climate?
Yeah, so I agree that housing has slowed down, sales volumes have plummeted, and there are some incredible opportunities. In the past 7 days, we've had 3 clients purchase properties, all significantly under the listing price, and even more significantly under the original listing price. So, as I'm sure you're aware, lots of sellers have opted to, reduce a price. Like if they wanted $1 million, they'll reduce it to 900,000, let's say, and clients are swooping in and getting it for even less than that in certain areas, in certain markets, for certain situations. So really the advice is, hey, like if you have a down payment, if you have something and you're looking for a deal and you can manage these monthly payments for the next 12, 18, 24, 36 months, my, oh my, there are some amazing deals out there.
One more thing I wanted to ask you about: renewals. Talk to me about renewals, because a lot of people who are coming up on their 5-year term and had maybe secured, an amazing rate back in 2018, right? Or are coming up for renewal that had purchased in 2019. How are you having those conversations right now where people are kind of looking at their monthly, payments and saying, my payments are about to go up by 40%. How
Yeah.
am I going to do this? What products are being offered? How are banks communicating with people who they have mortgages with right now that are running up against that problem?
So I'll answer that in two parts. First part is banks are not communicating with their clients. I'll have a call every other day from a client saying, "Hey Jeff, my bank offered me this," and my jaw drops because if I'm applying with this client to the same bank, we're getting a much lower interest rate. A little bit of like price gouging, and it's super unfortunate, but the numbers like 48% of people will accept a bank's offer on time of renewal, which is, it irks me because banks know that clients are in a challenging spot. Maybe they don't qualify anymore and they have to accept this offer, or they just, every bank knows how to make money. But when it comes to renewals, you're right. Like if you are doing a straight renewal, depending on your situation, your payments can increase by as much as 40% from what you're paying today. So a couple different ways to combat that. One is, hey, if you can manage, great. We'll shop around and ensure you're getting the absolute best mortgage rate, so that maybe that 40% increase, payment increase that your bank's offered you, maybe that reduces to 32 or 33 or 34 or something like that. Alternatively, if you cannot afford that, then we have an opportunity to increase your amortization back to the original term, whether it's you got a house 5 years ago, you had a 25-year amortization. Instead of renewing at 20 years, you can renew at 25 or maybe even 30 years to kind of help those monthly payments. So instead of a 40% increase, we're looking at somewhere between like a 13 and 18% increase in payments.
And are banks kind of, when you're talking about increasing the amortization on those mortgages, essentially what banks are looking to do now, if people are, let's say, have hit their trigger point, have not increased their payments, need to re-amortize, need to knock down those monthly payments, basically what banks are looking to do is, if I'm understanding this correctly, is just capture some of the client's equity in their home. If I'm not mistaken, am I off on that?
Like not as much like capture, I guess in a way. Because in those 5 years, for example, if you bought a house in 2018, the value of that property today is going to be, I don't know what number we want to use. Maybe conservatively, very conservatively, like 7% more than it was in 2018. I think it's a bigger number than that. But so yeah, to re-amortize, or even like some clients are, you can tap into, so there's two different ways to do it. One is you can tap into the equity of your property. And if you're really strapped for cash, you can pull some of that equity out to help with these monthly payments. But the other way of looking at it is, all we're doing is essentially saying, hey, it's going to take an additional 5 years to pay our mortgage off, which will reduce that monthly payment by quite a bit. But we're paying more interest that way.
Right. Over the long term, you're paying more to the bank. And so,
But in the short term, if it's helping you survive on a month to month basis, then maybe that's, something we need to consider.
so then what is, maybe I guess I might have confused these two things. What happens to those people eventually when the time comes where their amortization has already been stretched and they've hit their trigger point, they haven't increased their payments, the payments are not covering the interest, and now the bank cannot renew them at a, 50-year amortization. They have to renew them at a 30-year. What happens to those people then?
So those people are all, it hasn't happened yet because we're in, most of the time they, anyways, we'll find out over the next little bit, but pretty much what's going to happen is if a client for whatever reason wants to renew with the same lender that they initially got their mortgage from, so CIBC, TD, RBC, and I believe that's it, and BMO, they offer those static payments. So that's what you're referring to, those static variable payments. So if
Not
clients,
anymore though, right? Like I don't think they offer them anymore, do they?
they do, my friend, they do.
How are they still offering that
It'll
same
change.
product?
It'll change eventually. They have to because of situations like how it's been over the past couple of years. But right now, they're all offering it. Everyone except for Scotia. Um,
Isn't that
yeah,
what kind of got us into this mess to begin with?
100%. You got it. It's
So
it's it's scary, very scary. For the right person, like that, it's a good product, but not when we've had situations like this. So I've gotten calls from clients who said, "Hey, my bank called me to say, hey, I have to increase my payment." But there's no one's enforcing that. Like for some green lenders, like no one's enforcing these increased
they
payments.
can't, right? They can't default. They can't force a power of sale on that many people because they'd be devaluing their own portfolio of mortgages. So you're right. If they push all these,
And
houses
it's
onto the
not
market.
in like, when the client initially signed for that mortgage, they signed for that static option where payments will not increase or decrease. So they can't come in a couple, a year later, 2 years later to say, hey, actually, we changed our mind. You do have to make these payments or increase these payments. So to answer your initial question is, clients are going to likely have to move to new lenders at time of renewal anyways. And when that happens, it's just like you're requalifying for a mortgage based on whatever term, whatever mortgage amount you have left, whatever current rates are. There won't be an impact to clients if they choose to move lenders. If they choose to stay, they're going to have to, if you sign for a 30-year amortization and you're trying to renew at 25, but you've kept that same monthly payment through all these rate increases, you're going to have to make a huge lump sum to bring your amortization back to 25 years. And not many people have an extra couple $100,000 in the bank account.
Right. So they're going to have to refinance. They're going to have to go through that qualifying process. They're going to have to go through an appraisal. And this is where things I think get a little tricky, is that basically everybody is betting on or hoping that prices or values of their home will increase enough to compensate for the huge gap in what they're owing the bank, or the gap in their stretched amortization. So if
You
what
got it.
happens if values don't meet that?
So try to give like a quick example here. So let's say somebody bought a place for $1 million and they put 20% down. So they have an $800,000 mortgage and they made 0 monthly payments, or they didn't increase their payments at all. They've had this static variable rate. After 5 years, if rates continue to stay where they are, they probably have a mortgage amount around 820,000. So they've probably like increased unfortunately, they owe more now than they did 5 years ago. If housing prices do not increase or go down, and that property is worth less than $1 million today, lenders, banks, everyone in Canada can only lend up to 80% of the value of the property. So if the property is worth less, then somebody's going to have to make up that difference, and it'll be on the client to make up that difference in cash, or they're going to have to sell.
That's kind of the concern, right? Is that if they have to sell at time of renewal, which we are coming up on those points of renewals, not next year, but certainly in 2025, the concern is that too many people will be forced to sell at once. The banks have a vested interest in those price points staying at what they need to be in order for their loan to value ratio to keep them protected. And if everybody gets forced onto the market at once because of this very issue, that's not only bad for consumers, that's bad for the banks as well. At which point they also wouldn't want to be funding the deals for the buyers that are purchasing those very same houses, which, I mean, that spells complete disaster. That's like 2008 all over again. So how are we what steps are the banks currently taking in order to mitigate that?
So maybe you've seen, maybe viewers have seen, but there's been a lot of fines handed out to certain banks because of the underwriting that they've done, or how many of their deals are where there are exceptions needed on the file. So what banks have started to do is really limit the number of exceptions, which are like debt servicing pretty much. So how much debt family or a couple or an individual can have on their mortgage, or anyways. So what lenders are doing now, so I got an email a couple last week saying, it was a very straightforward deal that was submitted, a little bit of an exception, but my oh my, like nothing compared to what we used to send in. And I got an email saying, hey, it has to be sent to risk. We were told a couple days ago, anything over X amount needs to be sent to the risk department of this certain lender. It's like, that's new. I've never seen that before, with like such a slight exception. So I think what's happening is lenders are just starting to be a lot more aware of the amount of deals where exceptions are needed and trying to really cut that down.
Talk to me about these fines. I wasn't aware of that. What fines are, and by what governing body? I mean, these are the same governing bodies that these banks are lobbying to, create policy that's in their favor. Who's fining who and for what?
So it's OSFI that is fining, like CIBC was the latest one to get fined, and they were noted, I guess a big investigation happened, and they said, hey, a lot of your mortgages were funded based off of like just terrible underwriting and some documents that are not real documents, like a little bit of fraud activity in there. But more so, it's just, hey, like the ratios are out of whack here. How are you approving these mortgages? What's going on behind the scenes? So those are that's how that was the latest lender that just got wasn't a huge fine, a couple $1 million, but a fine nonetheless.
Isn't OSFI also the governing body that dictates how far amortization can be stretched on these loans? Isn't that the same governing body that pushed it from 20 years to 25 years to now 30 years? isn't that the same governing body that is probably going to push it farther because we're stretched way too thin already?
You got it. You got it. And speaking of that, we just got an email from a specific lender that now has a 40-year amortization product as of earlier this week. So
Who's that?
it's a monoline lender, a non-bank lender that's offering that on their alternative side. But a 40-year amortization is it's long, and I'll give you a quick example. If you have a $3,000 a month mortgage payment, you're paying around $250 a month towards the principal balance of the mortgage, and that the $2,750 a month is going towards interest. You're essentially making interest-only payments.
So basically, every single mortgage that we've seen, I guess, executed in the last, let's call it 3 years, and now everything that's going to be renewed upon that where people are, I guess, stretched too thin. I mean, these are becoming essentially HELOCs. These aren't even really mortgages anymore.
They are. No, 100%. Those interest only, like, yeah. So I just ran the numbers behind the scenes. I was actually overestimating it. So in a $3,000 a month, if you have a $500,000 mortgage with a 40-year amortization and today's interest rates, $190 a month is going towards principal and the rest towards interest, which is very, very scary. And these are these types of conversations we're having with clients where, like, is it worth it to get into the market today when the only person that's really making money is the bank until your property increases in value?
Right. So the whole thing is based on the market moving up. That's what every single thing is really depending on right now. And if it doesn't, we're all in trouble, because how are we giving out loans that can never be repaid? The only logical explanation for that is, well, the equity increase on it, because supply is low enough, demand is high enough over the 5-year term, it won't matter, basically, because the equity is increased enough that it doesn't matter if you could have never repaid the loan. You just took a leveraged investment and it paid off.
You got it. Yeah. And then the expectation or the hope is that, hey, sure, this term of this mortgage, these 3 years are going to be absolute crap when it comes to percent of payment allocated towards interest versus principal balance of the mortgage. But after that, when rates come down and property values go up, then the number's going to make more sense for us. So, it's more of a long-term view, but yeah, this 40-year amortization was the one that really, when just running numbers, they're like HELOCs. It's the same as a HELOC.
So basically, kind of boils down to the same old thing, is that right now the market is trending downwards 100%. Months of inventory is going up, consumption rates are plummeting. And so anybody who is selling right now, who is on the market, is not on the market because they want to be, it's because they have to be. And so there are definitely deals out there for those who have the cash reserves in the form of a down payment to make that purchase. But for everybody else, it's a buckle up, sit tight if you can. Hopefully you have some cash reserves to ride this thing out. And we're looking at, I mean, a year minimum before things stabilize again, according to Tiff McClem, who, I mean, just like me and you, is wrong a lot of the time, right? These economic systems are just so large that it's not possible to predict anything with any kind of accuracy or certainty. It's all just guesswork. And that's kind of what we've seen out of the Bank of Canada time and time again, is that they'll make a projection. The projections are way off. Then we have to kind of rejig things, and we're just kind of stumbling our way through this. Is that kind of the overall sentiment? Am I getting that right?
100%. So everyone that I've spoken with today, in the past couple hours after the interest rate announcement, has said the exact same thing. And these are people who make predictions and are, quote unquote, right on their predictions, maybe 50% of the time, but that's a pretty good number in today's
That's great.
environment. Yeah, it's
That's
great.
great.
they've said the same thing. We're done. We're done predicting, because something could change, and then the interest rate announcement in December is going, anything can change at any time. So if viewers want a best guess as to when rates will come down, when variable rates will come down, I would say the absolute earliest would be third quarter of 2025. 2024.
Oh,
So in the
geez,
next,
you scared me there.
yeah, next 9 to 12 months, really. I don't think we're looking at anything before then.
Okay, so the message is buckle up.
As the name of your episode there.
Yeah, you bet. I'm definitely gonna SEO test that one, but I think buckle up is a good title for this one, because that's definitely what we're in for. We're in for a rough ride, ladies and gentlemen.
Even with, it was good news today. Overall, good news. No hike 2 months in a row. There's the positive. There's the benefit. I think the rest of the stuff we were talking about has been an issue, like you said, for the past 45 plus days.
Right. So, I mean, we're now looking at things, I think, in a more realistic sense. I think everyone's becoming a lot more of an objectivist about what the outlook should be. And I think, at least for now, expectations seem to be anchored, which I think is a good thing for consumers, that they're not thinking about, what could be. FOMO has completely evaporated, which is nice. And now people are making more responsible decisions based on a more grim outlook. So, in a sense, it is a good thing. I just think that right now, for those who were barely hanging on, it's like it's a tight spot.
Yeah. It's a buckle up and figure out, make sure, it's a buckle up and make sure you have the right people in your corner that's giving you the best advice they can. And there are options. So for people who are, I've had a lot of conversations, really hard conversations with clients where they don't want to sell and they can't make their payments. So these are very challenging times, very hard conversations to have. But we kind of have to look at what's in the best interest for you and the family long term, and just kind of game plan accordingly.
It's funny that you mentioned that, because the banks are so wish-washy in the messaging they're sending out to people. I just had a conversation with a client who who in 2021 secured a fixed payment variable rate. And and he said to me, well, the bank's been trying to contact me for a while, because he's with TD, because I've hit my trigger point. And then when I finally got to speaking with them, they were telling me I need to increase my payments or make a lump sum. And I knew that, I didn't need, this is what he tells me. I knew that I didn't need to do that, because that's not what the agreement was. And so I asked them, the rep on the phone, what happens if I just ignore you? And and the rep says, well, let me ask my manager. I'm not sure. And so what happens, Jeff?
That's a great question. I've had the same conversation with a few clients who felt like they were strong held into increasing their payments, and I asked them, hey, I told them, I wrote the email for them to send to that person who called, and the answer was, well, you don't have to, but it's strongly encouraged.
Why is it strongly encouraged?
Because how does that make based on our conversation, how does that make the bank feel when their amortizations are at 92, 95 years on these mortgages that they have held? It's risky for the bank. Their investors don't like it, and they want more money in their pockets.
But they can't actually do anything about it.
We'll see what happens. Today, I have not heard of a situation where a client has been told, you absolutely have to do this or we're going to take the house. So the answer today is no, they don't. Certain lenders, every lender is a bit different, but for example, like RBC, they have it written in all of their static variable payments that they can't, if it hits the trigger point, clients do have to increase their payments. It's just that green lender did not have that, hence why these clients are like, screw it, we'll take a 100-year amortization. Eventually, it'll work out
if prices go up.
if prices go up. You got it.
Right. So they're saying, well, what if we just ignore the bank? Prices are going to eventually go up because immigration has gone to, all-time highs by a large amount, by double. And eventually, when things cool down, 2025, 2026, with inflation, then interest rates will settle. Demand will still be pent up and built up over the years of immigration that we've done through our economic programs. Prices will increase, and then we'll be fine. But why pay the bank more than we need to? And
if you can stomach that extended amortization, that you're losing money monthly by owning your home, if you can stomach that, it is what it is. As long as, like you said, the property values go up. I have two quick things for you, if you don't mind. One, I just still find it like absolutely incredible that in 2022 they expected 500,000 new immigrants. The number came out, it was just around a million. So they miscounted by 500,000. Anyways, I don't understand how that's possible. Second is, I really been wanting to talk to you around your thoughts of what's happening in BC and the Airbnb situation that's going on there, and if you think that would ever happen in Ontario.
Oh man, yeah. So can of worms there
For
to
another
open up.
episode, but yeah.
No. It's very interesting, and I typically like to watch the BC market a lot more carefully, because the Vancouver market in particular is kind of the Toronto beta testing ground. So if you just really look at it, any kind of real estate changes or real estate legislation that hits Toronto usually hits Vancouver first. And so unfortunately, I have a lot of realtor friends out there who I know through, different networking events, conferences. We're part of the same groups and things like that. Friends of mine, they're kind of like, they're in the sandbox for changes to real estate legislation, changes to the market. And so they get the, short end of the stick on that, because we kind of watch what happens there. We see if, hey, that change ended up becoming, like a shit show, or oh no, it was really good in the end. And, we kind of make our changes based off of that. The Airbnb situation is frankly a disaster. We have a big problem happening out west with that, because the economy is slowing so rapidly globally, especially, and with China in particular. Vancouver being such a hotspot for the Chinese market, both investing and for just general travel. Those people who had really bet on the Airbnb performa at the time, where the numbers looked great, are now sweating buckets. I think that we're going to continue to see that. I think that a lot of the restrictions that we had put in Toronto on Airbnbs, especially in the downtown core, ended up being a good thing. But who would have guessed that, right? At the time, it's just another curtailing of freedom, right? And freedom of capital movement. So, and we don't really know how these things are going to play out. I think that there are a couple of legislative ideas that have been happening in BC that we should be really keeping a close eye on here. Number one being the cooling off period. They've instituted a blanket cooling off period for 10 days for real estate purchases in the resale sector. We've already had that here in the pre-construction sector, because with new construction, builders and sales offices for builders, there's a lot of pressure tactics happening in those sales offices. it didn't really slow down their sales to institute the cooling off period. The contracts are very, very different because they're all builder standard forms. They have a lot of stuff in there that kind of limits the capacity for resale prior to closing. There's just a lot of you're at the behest of the builder. There's a lot of things in those contracts that are not favorable to the consumer, but you don't have a choice and you don't have negotiating power. It is not easy to negotiate with a builder. In fact, it's almost impossible. You have to have people that are working to bring you the product that are using their weight to negotiate favorable terms for you before you actually get to the negotiating table. Those are usually agents who deal exclusively with pre-construction. And I know I'm going off on a tangent here, but I'll kind of circle back and tie it all together. Because they've now taken that same concept and instituted it in the resale market based on prices going up and buyers having a hard time. Now that the market is turned, we're seeing a lot of nefarious activity that is happening, but on the buyer side. So now buyers are kind of more in the driver's seat and are putting lots of different offers on lots of different properties, tying them all up, using that cooling off period to then negotiate with all of them after the point of contract. So during a conditional period, try to give everybody a haircut, see who's going to give them the best deal, and then let the others go. That's also not fair to, number one, their other competitors, but also to the sellers themselves, because they're not making offers in earnest. It's not an offer in good faith. It's just a tactic. And so they're gamifying that legislation that was designed to protect them. And so that is nefarious activity. I think that the same thing is happening, but just on the Airbnb front, where people were trying to gamify the system using the Airbnb. They took that risk. That was their decision. The government didn't like people suppressing housing for actual residents in Toronto, and so they stopped it here. However, they didn't stop it outside of the city. And so I think that the cottage market is feeling it the most right now. And
Yeah.
they're going to continue feeling it. They're going to be, I think, the most impacted segment of our market when it comes to the Airbnb crisis or fiasco that's going on.
Yeah, I think those are all like really good points. And the other thing is, I think just like how I think most people thought the cooling off period was a or is slash was a pretty good concept, good idea to kind of have a built-in financing condition, essentially. But also, people found ways to gamify it. And I think people will find ways to be nefarious or creative or however you want to frame it. But people will find ways to kind of skirt some of these rules or these legislations in their favor. So I don't think that's anything new. I think they've been doing it for years and years and years.
Totally. I think that we just need to be very, very careful with legislation. And I think that when, emotions run hot and people are very upset, and you hear a couple of terrible stories that come out in the news that are very much the minority, not the majority of situations happening, and it causes a bit of an uproar, that kind of thing gets spun out of control into new legislation, which then ultimately harms, and I guess it's just the same old, the same old story of just the road to hell is paved with good intentions. And I think that that's what I think we're very, very much in the position of seeing. Like, we have a lot of incentive for that type of behavior now, and we have a lot of public support for that type of behavior now. And I don't think that anybody's looking at it in the long term and thinking that this could be harmful for both buyers and sellers, or for just consumers even trying to rent. Nobody thought that, for example, rent control would be bad for renters, but that's dependent on which renter you are. Are you getting into the market, or are you already in something?
Yeah.
So rent control is great if you're already in something, but rent control is terrible if you are trying to get into something, because all it's done is increase the barrier to entry and made every single landlord paranoid to the point where if you're not a doctor, or if you're not Mark Zuckerberg looking to rent out their unit, they don't want you, right? They're scared. They understand what the landlord tenant board would do to them if and how the odds are stacked against them in any point of conflict. So,
I was
you know,
just talking, to an investor client who was saying that, hey, like I have like this, me as the investor, I have all the power to decide who I get into the unit. It's all on me. Unfortunately, renters who are trying to get in, it's not up to them. However, once a tenant is selected and once they're in a property, the tenant essentially has all of the rights at that point. So
right. We need
it
more
flip flops.
balance. We need more balance, right? Like you can't have all of the power weighted on one side, and then the second something flips that, like a, a, a clock strikes 12, all of a sudden the power flips on the other side. What it does is it creates huge incentives on either side to be restrictive to the other, right? And so I think that the the friction that causes is a bad thing. We need to create relationships that are based more on volition and less based around the coercive forces that the legislation provides to both sides. So
Unfortunately, I think you and I agree. That's like it happens with all aspects of life, not just real estate. It's, it's more of a short-term view, and it's can be probably pretty harmful long term. We don't know how this Airbnb one's going to go long term, but just off the top, like how happy are hotels right now? They can do kind of whatever they want, and in terms of price, and gouge certain times because who's their competition? The other seven big hotels in the city. Anyways, um, there's a
I,
lot of different ways to look at. Yeah, I agree with you. Legislation has its place, but can be pretty scary.
we need to be super careful right now. I think that we have in Toronto in particular, I mean, our new mayor, Olivia Chow, is coming out with all of these ideas that they don't, the numbers don't add up. They don't make sense on paper. She's coming out with now, especially a new housing plan that's $36 billion that's going to add 18,000 units over the next 3 to 5 years, and asking for anywhere from 500 million to 800 million from both provincial and federal levels of government each per year. Like that doesn't make sense. You can look at and also she's saying that the municipality or the government will be a public builder for a few of these sites. We're talking about a cost per unit that is unfathomable for a product that's going to probably be terrible, right? Like this is government housing. It's not going to be good. And so this is not something that we're, have never had and we never played around with. We know what the outcomes of these things will be. And it's just because there is there's so much friction, people are having such a hard time that it's easier to become more sympathetic to these radical proposals. And I think in the long term, it's really going to hurt the city and it's going to hurt the greater market in general. So yeah, we'll see, but definitely a lot to discuss after today's interest rate. And I appreciate you taking the time. And I know you probably have a super busy day ahead of you, so I don't want to keep you for too long. But yeah, any final kind of thoughts for anybody who's watching right now who is kind of trying their best to either manage within the housing market or get into the housing market?
Yeah, it's to, as I mentioned earlier, to reach out to people you trust who are experts in the industry and get their point of view on things. I learned early on that I'm not the best cleaner, I'm not the best cook, I'm not the best with my own finances. So guess what? I hired out. The great part about real estate is when you're a buyer and using a realtor, there's no fees, no money coming out of your pocket. When you're a buyer and using a mortgage broker, there's no money coming out of your pocket. And these are people, or we are people who work in this industry. We have these same conversations we're having on YouTube today. We're having these 100 times a day with many different people. So if you have questions, just reach out and we will do our best to help educate.
Jeff Mudrick, thank you so much yet again for coming in and chatting with us. And we'll catch you on the next one.
Thank you, Adam.
Thanks for listening. Don't forget to like, follow, and give us a review.